We have a great show lined up for you here at Retiring Well. Going to be covering topics such as inflation in retirement. Inflation is a hot topic right now, so you want to be paying attention to this. What about when do you need a trust? How vital estate planning can be for you and your loved ones. PE ratios, and one of those financial terms that you may have heard of but want to learn more about. And lastly, active versus passive management. That's a very important information there to be shared and for you to learn a bit more. So stay tuned here on Retiring Well.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Inflation in your retirement years, as that's a hot button topic right now, as we're seeing inflation at higher than historically average numbers. What impact is that going to have on you? You always hear about, oh, I'm in retirement, I'm living on a fixed income. So that's where inflation is going to play a maybe even bigger role for you in your planning. So you think about your Social Security income. There's a cost of living adjustment, as we saw that bump up significantly here this past year to try and help out with some of those rising costs. But what about, if you maybe have a pension? Is that a flat pension where the number doesn't change throughout your retirement, or is it something where they adjust with inflation? There's other accounts out there. Perhaps you have some type of annuity that with an insurance company that's paying you some type of income. Again, are they paying you a level or fixed income throughout your retirement, or is it one that has some type of increase built in where your payments are bumping up over time? So those are all different important areas to be thinking about, but also what is it that you're spending money on in retirement, and what are those, what's the inflationary impact of that? Obviously, you're going to see food costs increasing, you're seeing gas costs right now increasing. So what are those areas maybe within your budget where you find yourself spending the most money, and really look at that to determine, okay, how much is that area specifically going up from a cost perspective? The other area that I think of is your retirement phases. So you have those go-go years of retirement where you're on the move, and then it sort of goes to the slow-go years where, okay, you're still spending money, but maybe not as extensively as you were during, say, those go-go years. And then now it's the no-go years of retirement where, okay, you're just not going to be out traveling as much as you were before, maybe spending more time at home and not spending as much. That's something that over the past 17 years here at Centennial Wealth Advisory that I've watched of clients where in those early years of retirement, we strongly encourage you, go and enjoy it while your health is still strong and you're able to enjoy those different retirement years, knowing that usually it seems to be sort of mid-70s or maybe into your late 70s where you start to slow down a bit more, not doing quite as much, and then knowing that perhaps into your 80s, and that may be different for some of you, but at that point you're probably not going to be spending as much. So again, inflation is vital in your retirement plan. We encourage you to give us a call if you want to talk more about this.
Hey, welcome back. Hopefully you got to find some different options that you might want to look into when it comes to how inflation might impact your retirement plan. Maybe another way to think of it is just to ask yourself the question, what's your COLA? Do you have any cost of living adjustments to try to keep up with the inflation? Well, Social Security, maybe that is going to be something that we can predict what that might be over time. Maybe you have a pension that has Social Security adjustments. That's something that you don't know unless you dive into. I know all the time, I'll be in the Cadillac office and we'll be going through their fears as far as inflation go, and I'm looking for COLA. I'm looking for, if they do have a pension, do they know what that is? Is it simple? Is it compound? How does that pay out? How are you positioned from an investment standpoint? Do we have any hedges against inflation? If that's a fear, then we should address that fear. And that's one of the good things that we get to do is we first need to get to the heart of what might be worrisome to you, and then we just we address it and we do something about it. We don't just let those get locked up and stress us all out. So if you're at all worried about how inflation might be impacting your retirement plan, please give us a call. Come meet with one of us here at Centennial Wealth, and we'll help map that out and get you in the best position possible.
Absolutely, Jack. I mean, that's great points there. And what kind of stuck out in my mind is that fear. And fear, I mean, inflation is a big fear right now. And maybe you don't have that pension where it has that Social Security adjustment. And a lot of people don't in today's day and age. So really, you just have Social Security that's supposed to keep up with inflation that historically, I mean, has it sometimes. But another thing you want to think about is the assets, right? I mean, you want those to keep up with inflation as well. And in order to keep up inflation, you kind of have to take a little bit more risk for a portion of those assets, right? I mean, it goes back to the bucket approach. You don't want all your assets in the growth bucket, but you do want a portion, because in that growth bucket, that's what's really going to keep up with inflation. So it's just mapping all of your assets out so they each have a certain purpose that you want to accomplish. So hopefully you found that very valuable. Coming up next, we're going to be talking about when do you need a trust, and then PE ratios. Stay tuned.
If you're retiring soon, it's likely you have many decisions ahead of you. One of the larger ones is Social Security. How are you going to take it? Are you going to take it early? Are you going to take it at your full retirement age, or maybe even delay it? Social Security needs to be viewed as an asset. If you live a long life, it's likely you can collect a large sum of money over time with those payments directed to you. How, though, folks misjudge Social Security commonly is how it's taxed. How are you going to pay tax on that for the rest of your life? And it's important to factor that in when to take it. And also paired with your other assets you may have, it may make great differences as well. If you don't have a Social Security tax plan built into your retirement, it's extremely important and could cost you thousands over your lifetime if done improperly. We would love to sit down with you here at Centennial Wealth Advisory and talk through what that looks like on a larger scale and see if we can help you have a successful retirement.
At Centennial Wealth Advisory, we take a holistic approach to your retirement planning. So it's not just looking at what your investments are, but what is that long-term income plan for the next 30, 40 years of your retirement? What about taxes and what role they play in your retirement plan? Estate planning, what about life insurance, health insurance planning, all key areas to consider when looking at your retirement. So please visit our website or call the number on the screen. We'd love the opportunity to sit down with you for a no-cost, no-obligation visit.
I want to take a couple minutes and talk about the topic of trust. You know, I'm not an estate planning attorney, obviously I'm a financial advisor, but we partner with them almost daily for our clients to make sure their estate planning needs are taken care of. You know, one of the most common things I see them talking about, and as long as people wondering, is when do I need a trust? Do I need a trust? When should I get one? All these various things. So from kind of experience in a lot of these situations and in conversation with folks, there's kind of four primary things or common things I see that rise up in a lot of cases when people should consider them or, you know, definitely have additional conversations. The first, estate taxes. You know, some time ago, the estate tax threshold used to be much lower. You know, since then, as of 2021 here, the estate tax threshold for an individual, $11.7 million. So if you have under that, you may not have to worry about estate taxes depending upon your situation, but you know, that's an area where some folks with planning may need to consider doing specific types of estate planning to try to minimize or avoid estate tax if possible. The other thing that's out there is to avoid probate. Right? You know, you hear about that all the time, you know, people passing away in their assets or their estate going through a probate court situation. Well, folks, all your possessions, you know, whether that's financial instruments, property, real estate stuff, it needs to know where to go when you pass away. And if that asset doesn't know where to go, well, then it has to go through probate court so they can tell it where to go. So with estate planning through trust, it can do that. So a very good, well-rounded, properly executed estate plan would make it so most of or all of your assets don't have to go through probate court. The other possible scenario where some advanced estate planning may need to take place is with a special needs child or special needs individual you're caring for. You know, in many cases, they're entitled to some sort of aid or disability or whatever it may be. And if they inherited a large sum of money from your passing, it may disrupt that. It may cause problems for them and potentially could even cause it to where they wouldn't be allowed to receive that aid any further or for some time. So proper estate planning needs to be taken care of in those situations. And the last one I'm going to talk about today is, for lack of better terms, dictating from the grave. You know, deciding where specifically your assets are going and when or how people can access them. So let me give you an example. Let's say you have a child that maybe isn't so great with money, and you're concerned about them inheriting a large sum of money that would be fully theirs and they're fully in control of at one time. Well, maybe you're concerned they're not going to spend that appropriately or the way maybe you would wish, or that they're going to blow it or not pay off bills or whatever the reasoning may be. So with estate planning, you can set boundaries or controls of when they may have access to that money and how much or for what reasons. So it's a way for you to kind of put your wishes out there and make sure maybe that next generation is well taken care of for that situation. So if this is some of the questions you have, or you're wondering yourself what estate planning should be taken care of, make sure you're speaking with your financial professional and they're incorporating that team together. If not, give us a call at the number on the screen and we'd love to help you.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Are you drawing closer to retirement or already retired? Do you feel confident that you have a plan in place for your retirement? At Centennial Wealth Advisory, we believe there are a number of areas within your retirement plan that must be working together. It's very important that you have a long-term income plan. You don't want to run out of money in retirement. And we believe that tax planning should go hand in hand with your income planning. So we have our very own accountant on the team to assist you. We also believe that you need to have your estate planning in order to ensure that your assets are left behind to your loved ones and/or charities. Along with that comes insurance planning, whether that's life or health. Along with all of this, obviously comes your investment planning, which you need to have confidence will help you accomplish your goals and objectives. As you can see, there's a number of areas that you need to be taking into consideration when it comes to your retirement planning. We'd love the opportunity to share with you how we approach all of these areas within your retirement plan. Please call the number on your screen.
Are you nearing retirement or in retirement? Have you had your portfolio just looked at or have a second opinion on that portfolio recently? Centennial Wealth is a full service advisory firm and we have multiple locations in northern Michigan. I'm in the Gaylord office primarily. The office is right downtown Gaylord. Also up in the Petoskey office as well. That office is right off of 31. I'd love to hear your story. I'd love to sit down and chat, and it's a free, no obligation consultation. So just call the number on the screen.
PE ratios, another one of those financial jargon terms that you may hear when you're watching the news, or maybe your advisor has mentioned it before. Our job here at Retiring Well is to make sure to try and educate you on what all this means. So PE ratios, or the price to earnings ratio, is a ratio for valuing a company that measures its current share price relative to its earnings per share. So the share or market price tells you how much people are willing to pay, but essentially the PE ratio is going to tell you if the price accurately reflects their earnings potential or their value. So let's take, for example, a stock that's $100 per share, and it generates $4 per share in annual earnings. So the PE ratio of this is 25. So it's essentially saying it takes 25 years of accumulated earnings to equal the cost of the investment. Now keep in mind the higher the ratio, essentially the more expensive a stock is relative to its earnings. The lower the ratio, the less expensive. So stocks and equity mutual funds can be classified as a growth stock when they're above the average ratio. So also think back historically when you look at, say, an index like the S&P 500, the historic average PE ratio for a number of these stocks is around 16, 17 is sort of their PE ratio. So let's take, for example, though, as the date of this filming, Amazon's PE ratio is in the mid-60s. So they're definitely considered then a growth company. Meanwhile, you look at lower PE ratios, they're going to tend to be more of your value types of companies. So I looked, and again, as the time of this filming, Bank of America has a PE ratio around 13. So again, more of, say, a value type of stock. So the PE ratio isn't going to help you necessarily predict what those short-term movements are going to look like. As we all know with stocks, they go up, they go down type of thing. But the PE ratio helps you sort of measure the company's value. So again, if you're getting into different individual stock trading and all that, it's very important that you again look to diversify your portfolio and not solely rely on one stock, as we all heard the good and the bad of that type of investing, and how some stocks can really take off and do well, but just as quickly they can drop. So again, it's one of those where if you're evaluating your retirement plan and would like assistance, we'd love that opportunity for a no cost, no obligation second opinion.
Well, welcome back. Another great topic there in when do you need a trust, and then PE ratios. You know, I always think back of when we set up our trust. I mean, it was really just a weight lifted off of your shoulders, right? In my situation, I have 4 young children. Our oldest is 9. If, heaven forbid, my wife and I both passed away, she'd be getting a large life settlement, right? A life insurance settlement. She would have no idea what to do with that money. And that's why it was so important for us to have everything all set up in a trust in place to take care of our kids if, heaven forbid, we do pass away. But that's just one situation, right? Everyone's situation is so unique. I mean, number of clients come in and they're so worried, I don't have a trust. Do I have an estate plan? And theoretically, sometimes they do. I mean, if you have all your beneficiaries named on your assets, your money knows where to go, then it's your other assets like your house. Do you have a ladybird deed on that? A good estate plan means that all your assets know where to go when you go. That's all it is, whether it's a trust or in other avenues.
Absolutely. You know, out of the Cadillac office that I get to primarily work, you know, we're constantly asking our clients in a review, what does your estate plan look like? What do you need? What are you trying to accomplish? Let's do a red flag review to make sure those are all in good order. You know, I've had clients that have special needs children that they want to get that stuff for their estate in place. I have had other clients that, you know, are worried about some of the estate taxes, and so what are their options? Well, we need to explore that. You know, our slogan says plan to retire well. It doesn't say plan to retire worried. And so if you're worried at all about what your estate plan or lack thereof might look like, give us a call. We would love to meet and to help educate you on the areas of that plan that are in good order and the areas of that plan that are not in good order. You know, when it comes to the PE ratios, we do look at that, and it is a little bit out of line right now with what those historical averages are. But if you have more questions about how your investments might look, you know, again, give us a call and we can get into the analysis and dig behind those investments. Stay tuned. We're going to become talking about active versus passive management. Hi, my name is Jack Klunder, and I am a financial advisor with Centennial Wealth Advisory. I work out of our Cadillac office, and we specialize in retirement planning. We take a very holistic approach. We start with investments and see how you're situated there. We do wealth management. We do income planning. We do tax planning, any kind of healthcare issues or needs that you might have for insurance. And then we talk about what your legacy plan might be. So if you are nearing or in retirement and you have questions that you want to go over, please give the number on the screen a call and we can have and set up a free, no obligation consultation.
You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you may want to manage it. Use it to fund your dreams. Make it last as long as you need it. And leave some for those you love. So what do? Wall Street continues to be uncertain, and some conservative options have dropped through the floor. How do you maintain opportunities for growth and reduce risk of loss from market changes? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies and guaranteed retirement income you cannot outlive, provided by the claims-paying ability of insurance companies. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a complimentary consultation, simply contact us today.
All right, we're going to talk here about active versus passive management styles. You know, two distinctly different things that you may have heard about or wondering if they're appropriate for you. First, I want to talk about passive. Think of that word in nature, passive, meaning it's basically no change. So if you have a passive management style, typically your portfolio would be designed to mimic an index or have a set type of investment tools in place that are not changing or maybe just rebalancing quarterly or something like that. So typically you'll see less transactions and you're going to track whatever portfolio year was designed to do or benchmarked to. So minimal changes and usually set it and forget it, if you will, kind of sort of thing. Active management is going to be a little bit different. In the term, it's active. Usually you have a manager or a team of professionals that are set to manage your portfolio. Now, it may have different objectives in place. One objective could be to, let's say, beat the market. So they're trying to make investment decisions based on financial indicators and markets to try to attempt to beat some market index or S&P 500. There's other objectives that could be out there as well. Maybe it's to have capital preservation or produce income or whatever that objective is. It's being actively managed to try to meet that objective in the nature it has. So let's say you have an actively managed portfolio that's trying to produce income. Well, maybe some time ago it was holding quite a bit of bonds because maybe they had good interest rate and it was producing a decent interest with that. And so you would have held that. Well, as time has gone and maybe interest rates have dropped, maybe they need to be making adjustments. So they would be selling those and moving on. Remember, active managers are deciding when to buy, sell, and hold the asset to meet that specific goal. So what may be appropriate for you depends on a lot on what you're trying to accomplish. You hear us talk a lot about on the show, what is the purpose of your money? What are the goals of what you're trying to do? You know, some folks, maybe they're younger, or maybe that they're willing to take on more risk, or they have a big time horizon in their hands. Maybe passive is appropriate for them. Maybe you're somebody that's less risk adverse, or you have specific goals or timelines with your money. Maybe active is. Maybe it's a combination. It really depends on your individual circumstances of your situation. So folks, if you're sitting out there and wondering what you have, or maybe what you should have, give us a call. We'd love to sit down with you, give you a free, no obligations look at what you have, and so we can walk through all the different options for you available to make sure you can plan to retire well.
Hey, welcome back. Hopefully you enjoyed that segment on the differences between active and passive management. You know, one thing that I find quite often is people don't really have a good understanding of what part of their portfolio might be active and might be passive. You know, I find sometimes that these mutual funds that they hold that have very specific objectives that need to be followed don't have great options to move that risk if markets don't behave. You know, it is a relatively passive approach. And so one of the things I love to educate is, okay, where do we need to be active and nimble in our portfolio, be ready to quickly change if markets don't behave? What part of the portfolio is a little bit more passive approach, maybe a better way to go? You know, the first part of it is educating what your portfolio looks like as far as the active and passive. Maybe you don't have any active management. Well, wouldn't you like to know that? You know, that's what we get to do. We get to educate you about what that looks like. You know, because when you're saving for retirement, sequence of return risk is not in play. But as soon as you start taking money out of your portfolio, you have now entered into a sequence of return risk. And so that's important to look about, you know, what you have when it comes to active or passive management, and who's responsible to teach and make any of those changes.
Yeah, I think what I got from that, Jack, I mean, is just planning and understanding your plan. I mean, all your assets should have a certain goal, right? So you want to make sure that you understand which ones are active and which ones are passive. We had a recent scenario where a couple, they had all mutual funds. It was all passive investments, and they really had no idea. They just thought that's what you do. You ride the waves. You don't have to, right? You can get a portion of your assets and put it into an actively managed position where if the market does go the wrong way, you can make adjustments. So it's just important to understand what you actually have and the options that are out there for you. So thank you so much for tuning in. We look forward to doing this. I hope you look forward to watching it as well. Don't forget, come back next week, same time, same place, and we're going to have a lot more valuable information for you. Take care.